Okay, so it's not often that we film a mid-month rate update, but fixed rates are on the move. They are going down. We had widely expected this since about the end of July, but they just hadn't budged. And this week, one of the big lenders dropped their 5-year fixed rate, and that caused everyone else to follow suit. So we're going to talk about what rates are, where we're at as of today, and what you can expect going forward, and whether or not this should change your borrowing decisions with respect to variable versus fixed. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where when we hit 25,000 subscribers, and we just hit 17,000, so thank you to the 17,000 of you who have already subscribed. If you haven't subscribed, go ahead, click that subscribe button. It's free, it's easy, it's definitely worth it. And the winner, when we get to 25,000 subscribers, is going to win $5,000 to put towards their down payment, their savings, their mortgage, or simply do with what they like. But in order to win, you have to be subscribed. So go ahead, click that subscribe button. The definitive guide on how to manage your credit, product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss what is going on with interest rates, because since the beginning of August, end of July, we've expected that 5-year fixed rates would come down. And lo and behold, they just haven't come down. So we're going to talk about what happened. We're going to talk about what you should be doing with respect to selecting your mortgage. And we're going to talk about what the rates actually are. But first, let's go ahead. Let's take a look at the bond market, and let's take a look at what's going on. Because if you take a look at the bond market and the 5-year bond specifically, this is the bond that the 5-year fixed rates are priced off of. You can see that back in February of this year, it started to rise quite substantially. And that's where we saw interest rates go from basically 1.69 to 2.29%. And then they've kind of cruised along for the last little while, but then at the end of July here, we started to see this bond market yield come down about 20 basis points to where it's at 0.8%. And what that should have meant is we should have seen interest rates drop back below 2% on a 5-year fixed, but the rates just have not come down. And that is until the last couple of days. So let's talk a little bit about what's happening here. Why did they not come down? Well, first and foremost, middle of the summer, nearing the end of the year for most of the lenders, they've had record years, and they were pretty much in the position where they could say, you know what, we don't need any more business at the moment, so we are just going to leave rates where they are to try and increase our profit margin. So that's the first part of what happened. The second part of what happened and why they've come down and why they've stayed flat and low is because the bond market is basically expecting that the interest rate increases that were widely expected at the end of 2022 are probably going to take a little bit longer to happen, because when you have a 5-year fixed rate based on a 5-year bond, and that 5-year bond is going down, that's usually an indication that the market expects that in 5 years from now, interest rates are going to be lower than what they previously expected. Because when you take a look at timeframes, 5, 10 years, basically people make investments, markets make investments based on what they expect the interest rates to do. And if they're going down, that means there's a longer term, lower rate outlook. Now, before I get into the actual details of what the interest rates are and whatnot, I want to preface this first and foremost with anytime rates go down, it pretty much leads people to go into this panic mode of going out and trying to find a lower interest rate and just going after rate after rate after rate. And it's one of the biggest mistakes that people can make is chasing that rate, because while you might save 0.1 or 0.2% off your rate, it could end up costing you tens to hundreds of $1,000s down the road. And maybe $100,000 is a little bit over the top, although it could happen on $1 million mortgage, but on a $500,000 to $600,000 mortgage, it's very possible that chasing rates could cost you $10,000, $50,000, $20,000, $30,000, $40,000, $50,000 if you get into the wrong mortgage. So I want to preface this whole thing with the fact that before you go out and you start searching for interest rates, if you aren't using Mortgage 360 for your mortgage already, we've put together a framework that teaches you how to get the best rate while also making sure that you have the tools that you need in order to get the best overall deal long term. Because when you're looking for lower interest rates, that's what you're looking for, right? You're looking for lower costs on your mortgage. You're looking to pay less dollars, not necessarily less in interest rates. And I'll give you a great example of this. Variable rates. You can get a variable rate from Scotiabank and you can get a variable rate from RBC, both at 1.45%, identical rate. One's compounded semi-annually, the other's compounded monthly. The RBC one's compounded monthly, the Scotia one is compounded semi-annually, and the mortgage at RBC is going to cost you more over the long run. Now, that compounding isn't going to cost you tens of thousands of dollars, but every little bit counts. And here's the point. It's what you don't know that you don't know that will get you in trouble. So we put together a framework that basically takes you through how to get the lowest rate, how to avoid all the landmines, the surprises, all the things that come along with making sure that you get a better deal, not just on the rate, but on the overall cost of your mortgages. And we've put that course together. It's called Secrets to Getting the Lowest Interest Rate. And we've made it so inexpensive that if you are getting a mortgage, you're absolutely crazy not to purchase that course to make sure that you don't get stuck with some sort of clause or that you don't get stuck with some sort of mortgage that isn't flexible enough to save you money over the long term. So it is super cheap. We've put a special offer in there. If you decide to end up getting a mortgage through Mortgage 360, you'll get at least 10 times your money back. Otherwise, we expect people will get 10 to 50 times their money back just based on being educated and knowing the things to avoid as well as the things to look for in a mortgage, especially when you're going for that lowest rate. Because quite honestly, the lowest rate doesn't always mean the lowest cost. There's a link in the description below with a 50% coupon for a discount off the already discounted price. And if you are looking to get a mortgage and looking to get a low interest rate, I highly, highly, highly encourage you to take that course. So you have that framework for how to get the best rate while also not getting screwed. Now let's talk about where interest rates are today, because prior to today, a 5-year fixed mortgage would cost you in excess of 2%. And now that interest rates have started to come down because the bond yields have gone down, you can now get an insured mortgage or a mortgage with more than 30% down for 1.89% on a 5-year fixed. Now, if you're looking for a conventional mortgage where you're putting between 20 and 30% down, you can get that for 1.99%. So both of these rates, regardless of how much money you are putting down, whether it is 5%, 20%, or 35%, you can now get a 5-year fix for under 2% pretty much across the board. Now, would that change my decision making with respect to whether I take a variable or a fixed? No, I think that the variables are still significantly cheaper enough that it still makes sense to go variable, lock in some savings before interest rates start to go up. And since we're seeing interest rates trending down, it's a good time to take those variables and ultimately put in a strategy in place where we're saving money, but also watching for when interest rates start to go up and then potentially locking in at that time. Because here's the reality of it, is if you're taking a variable rate mortgage today on a $500,000 mortgage, you're still saving about 0.65%, which is about $3,000 to $3,500 per year. So if you can save $3,000 to $3,500 this year, and then let's say interest rates don't go up as expected at the end of 2022, and they stay the same and you save another $3,500, and then they stay the same and you save another $3,500, and then maybe they go up a quarter of a point and you only save $1,750 the next year, well, you're doing pretty well by taking a variable rate and just waiting to see what happens with interest rates. Now let's talk about variable rates for a second and see where they're at. If you're getting a variable rate mortgage with greater than 30% down or that is insured, which is less than 20% down, then you're looking to pay 1.35%. Now, these are full featured rates, by the way. I suspect that the discount rates are going to be even lower than this by about 0.2%, but these are full featured rates. You can move to a different lender, you can pay them off quicker. They have all the features, all the things. That includes the 5-year fixed rates that I just talked about. Now, if you're putting 20 to 30% down, you're looking to pay 1.45%. So when you look at the big difference between a variable and a fixed rate now, it's still making sense to go variable. And let's watch and see if these fixed rates get even lower and even lower and even lower. I suspect there's another 0.1% that they could go down. And ultimately, let's make the choice that saves us the most money right now. And then eventually we can start looking at locking into fixed rates if and when they do start to go up. And all the economic data that's showing right now, it's showing that the economy is struggling. We're going back into quasi lockdowns. Things aren't heating up as they were expected to. Looks like we're going to have some transitory inflation since a lot of the inflation numbers reflected increases in the price of gas, not necessarily the increases in other costs of goods. If you take gasoline out of the inflation numbers, we're only at 3.2% total inflation, which is still a relatively low number. And I suspect that that number is going to come down over the next couple of months. So again, if you are in the market for a mortgage and you are going to look for low interest rate, either have us help you at Mortgage 360 or go and take that Secrets to Getting the Lowest Interest Rate course that gives you the framework to make sure you get the lowest interest rate. And if not, if nothing else, if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers, and we'll see you on the very next one. Wow, that was fast.